over Wednesday, September 17th here. I'm actually a minute early. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure remains unchanged. My internet's been in and out all day today, and the internet guy is here, which actually just made it worse because he's been testing. Hopefully it doesn't go out now. If it does, I'll come back onto the VTF. I'll switch over to my hotspot and go to the VTF, but I will not go back onto the YouTube for anybody who may be listening on the YouTube. Okay, so let's jump in. Give me one quick second here. All right. So as of right now, and we're up a little bit from where we closed, it seems, but as of right now, the SPYs are unchanged. Unchanged. We're up a little bit from where they closed, but unchanged. The Qs are also up a little bit from where they closed, and they are unchanged. Wow. And the IWM is up 0.3%, still below 240. It's trading about where it was when it closed. TLT here ended up down, so we'll get back to the dynamic of TLT, IWM, and the Qs in a second post the Fed meeting. What else do we got out here? Oil down, Bitcoin down, Ethereum up, and gold down 0.8%. Okay. So the bottom line is, so we spent a lot of time in the morning meeting. We had a lot of great institutional research that we were reviewing in this morning's morning meeting. Some great stuff out of Goldman, some great stuff out of Scott Rubner, who is formerly of Goldman, now at Citadel. There's some good stuff out of JP Morgan. So a lot of really good institutional research that was out this morning that we were able to review. But in hindsight, the one that appears to really have been very accurate for today's trading session was this Goldman note. Pulling up Pat's note here. The Goldman note said their guess was a 25 cut with 2 dissents for 50 and maybe 1 dissent for a hold. It wasn't that bad, actually. They had less dissents than that. But basically what the Goldman note says is that their expectation is a non-committal Powell that reads as a bit of a hawkish cut versus hopes. Sorry, let me just reread this. From Goldman, my expectations is a messy vote with a few dissents and a non-committal Powell that gets read as a bit of a hawkish cut versus market hopes, but unclear equities move much. Not looking for a big sell-off and any downside. This is a really key statement here. Not looking for any big sell-off, and any downside likely gets absorbed by gamma, SPX event vol compression, and expiry-related demand into week end. That line there really, really sums it up. That couple sentences is pretty much exactly what happened today. If you circled back to the JP Morgan note that lays out like the probabilities and their expected moves, their highest probability was actually for a dovish cut, in which case they expected the market to go up a little bit. Their second highest probability at, I think, 40% probability was for a more hawkish cut, in which case they thought the market would be down by about 0.5%. So we got the hawkish cut. Both Goldman and JP Morgan actually ended up being correct on that. We had, a lot of volatility. We had an opening up move, down move. I'll analyze the price action and the charts in a minute. But eventually we closed pretty much unchanged here, maybe down really small, which is perfectly in line with what both Goldman said and with what JP Morgan said. Personally, they were right and I wasn't as right. I thought that a hawkish cut, given how much we've rallied into the Fed today, actually could give us more selling than it ended up doing it by the end of the day. There was a point there where it seemed like we were selling pretty hard. So I want to now have a review here of the market technicals, but I want to keep in mind this statement. Not looking for a big sell-off, and any downside likely gets absorbed by gamma and XPX event vol compression and expiry related to demand into weekend, because that is 100% what we saw here. I guess prior to 2 o'clock, just to mention that really briefly, we had relative weakness in the Qs, we had relative strength in the IWM. You can attribute that to a couple of things. One is a front running of the expected Fed cuts, so IWM relative strength, Q relative weakness, but also it was off the NVIDIA China headline. The NVIDIA China headline, China coming out and saying that they're not going to be buying any more NVIDIA chips, that companies aren't allowed to, and that created some degree of relative weakness. I still think that if it's proven to be true, those China statements, NVIDIA belongs a lot lower than this. But I think that the market's still discounting it, and I kind of disagree with this actually. I think the market's still discounting the words out of China as negotiation tactics for the United States versus China with the trade war stuff. I personally think that there's more to it than that. And I think that NVIDIA actually should be down even more on that headline. But the price action is what matters, and we did have a down day, and it led to weakness in the Qs. And the SPYs were, like usual, somewhere in between the IWM and the Qs, a little bit weak, but the RSP was up. The average stock in the S&P was up. There were more gainers than losers throughout the day. Then we got 2 o'clock. So 2 o'clock hits. The initial reaction to the move played out as follows. 25 basis point cut, and they moved forward a little bit to dot plot. So, generally a more dovish dot plot with the cut. And on that, you had this initial rip higher that was very straightforward. It was led by the IWM. The IWM massively squeezed up here in like the first 7 minutes after 2 o'clock. The Qs, we noted, were relatively weak. And the trade was, we discussed this throughout the day today, if you get a dovish cut, a dovish cut will mean that the market probably holds in better. The IWM leads up and the Qs are relatively weak. If you get a hawkish cut, which is eventually what we kind of got, then the expectation is that the IWM is going to be relatively weak, the Qs will be relatively strong, and the market overall will actually probably be a little bit weaker. That was my general thought process coming into things. The initial movement was that. It was the former. It was IWM relative strength. The language in, I don't even know what they call it, the actual statement that Bill K posted. I love that updated statement that Bill provides us with the actual change in language, like written in red. That statement seemed to me to be relatively dovish. And off of that, the initial move was relative strength in the IWM, relative weakness in the Qs. Recognizing that, and recognizing I was watching immediately at 2 o'clock some stocks in the Mag 7, none of them were moving higher. NVIDIA could barely uptick. I remember Palantir here could barely uptick. It was one of the first to lose its starting point. Other names like Google, that was such a weak looking bounce in Google. Microsoft, very weak looking bounce and immediately sold back down. Meta never even was able to bounce at all. I'm seeing all the relative weakness in these Mag 7 stocks, and off of that, as the Qs got into 591 and started to come back down, that was my first short call out, and it was specific to the Qs, and it was specifically because of their relative weakness. The trade worked great. We came down pretty hard. We broke the starting point. We broke the low of the day, and we worked our way down. The IWM was relatively strong. It pulled back to its starting point, but more or less held it and bounced off of it again. And then as time went on, we got into the conference and the Q&A. Things started with how Powell was speaking to sound more hawkish. And as things became more hawkish, the relative strength, relative weakness dynamic flipped. The IWM, all of a sudden, I remember noting, I'm trying to remember exactly where it was. The IWM, it might have been on this bar, actually, the 235 bar. Yeah, you could see here on the 2:35 p.m. bar that the IWM was breaking the 215 pivot low, but the Qs were actually still above the 215 pivot low. That was my first signal, as I was also listening to Powell become more hawkish in his words, that we were then getting a flip of the opening relative strength and opening relative weakness. And now it was the IWM that was weaker, and they basically stayed weaker for the whole remainder of the trading session. And eventually, when the market did bounce back, the Qs really led that bounce back. But within the confines of this, we had some great trade call-outs. We called out the highs in the Qs. We called out the short off of this pivot high in the Qs. We also even called out this more momentum-style short off of the 220 pivot high. All of them worked to some degree really, really well. And then, of course, I kind of got out of the way in when the bigger rip came on. You can also see it just with how the TLT traded, right? So the TLT, when things initially seemed like they were more dovish leaning at 2 o'clock, ripped higher, so interest rates were lower. But then you can see here starting at like 230, 235, which is the exact time in which the IWM became relatively weak. They had that flip occur. That was when TLT was actually going negative, and Powell's language was becoming more hawkish. Then yet, at the end of the day, we were able to close flat. I thought that there was a lot of things to be bearish about today, to be totally honest. I think that the NVIDIA stuff was very bearish for the market leaders, for the AI that was out pre-market and impacted those stocks a little bit throughout the day. And I thought that Powell was really pretty hawkish. My one concern, honestly, is the one Fed dissenter who wanted the 50 basis point cut, and where that individual's dot plot is and where that person is coming from. You even had the question, which Jerome Powell respectfully did not answer because the man is true class and the utmost professional. But you even had that one question that came from one person in the press about basically asking about Moran, who's the 50 basis point dissenter, who has a dot plot that is far and away from all the other Fed members, basically saying, hey, you have someone in the Fed now who's also like someone in DC in politics that's never really happened before. Is that a like conflict of interest? So the question was somewhere along that, and Powell, basically declined to answer and really was a staunch advocate of the independence of the Fed regardless of that. So, such a professional. But honestly, when you see how far in left field that one dissenter is compared to everyone else, and you hear language that comes from Donald Trump about, I'm going to get my people in the Federal Reserve, which is language that I couldn't disagree with more. The Fed needs to be independent. We should never be talking about any politician getting my people into the Federal Reserve. But if that is becoming the goal, and what my people looks like is extreme cuts, and he does in time get more of those people in there, well, then you're going to end up getting a dot plot that could continue to move forward over time. And that's actually one of the most bullish things that I could point to right now with this market, even though I do think it'll lead to an increase in inflation over time. I do have that as a little bit of a concern in the back of my head. But more straightforward, this was, I thought, a hawkish of enough Powell to get us to trade lower. We just couldn't stay down there. The market, going over the daily chart, traded down to the ADMA for the SPYs. It traded down to the ADMA for the Qs. So at lows, we fully satisfied the upside extension that the market has been dealing with for the last couple of days. But we rallied off of that support, and it circles back to the Goldman note, that downside positive gamma that's so supportive for this market. And we could take a look at the Rubner note in conjunction, because the Rubner note's where a lot more of the data is, in conjunction with the Goldman note that I mentioned. But you've got that really strong insulating gamma to the downside, It's on a previous Goldman note, they rated it as an 8 out of 10. I had seen, and it's probably even bigger than this now, a number of $11 billion on the downside of positive gamma. So into a down move, you just run into so much structural support. The interesting thing is that structural support is gone after Friday. So after Friday, there's a real opportunity for this market to loosen up. So, you know, we've just seen this happen so many times in trading now where it seems like the market should go down, but it just can't go down, and it's all structural. We saw this in February of 2025. We saw this in February, very notably, of 2020, where you had to, in both of those months, actually get to Fed OPEX in order for the real selling to be able to come in to force the market to go down, because otherwise there was so much structural support from the gamma environment and gamma cohort. And that seems to me what we're seeing right now, and it is exactly what that Goldman Sachs note predicted would happen. You're running into that gamma, and also a little bit of a post-event vol crush. And you can see that in how the VIX traded into the event, right? We had been noting the last couple days that the VIX was trading higher with the market. So you had a little bit of a divergence there, but we were putting a big asterisk on that divergence because it's not that unusual to see that in front of an event, because people are hedging themselves. And then that gets manifested in the VIX moving higher, in this case the VIX moving higher with the market moving higher. And then when you get through the event, those hedges get unwound. So that almost can create the opposite effect. When the market was, kind of crashing lower at certain points today, when the market was crashing lower at, when did we actually make the low of the day on the SPYs? I can't even find my low. We made the low of the day on the SPYs at 250. When the market was actually crashing lower, the VIX at 250 didn't even make a new high on the day. It did, elevate a little bit when the market was kind of crashing lower. It got as high as 1670, but it never actually was even able to make a new low on the day. And that's just because we got through the event. So you get that vol crush, you get an unwinding of those hedges, and that actually also creates a degree of supportive structure for the market. And then the final thing that the Goldman note mentions is obviously the kind of demand that's coming from options expiration for this week. So we got to get through this week is what it really seems to me. And that's more or less been the expectation from the beginning. I did think that there was a chance that if we could sell down enough and hard enough on what Powell says, that the vol control selling that would be coming in at 1% down, which is like $15 billion, could potentially overwhelm the positive gamma. I did think that was a possibility. It's clearly not what happened. So the market is still very, very structurally supportive, but it seems to me that we're losing that structural support now. You're losing the corporate buyback bid starting, per Rubner's note, starting on September 15th, so 2 trading sessions ago, but that's going to continue to get worse over time. More and more companies are going to enter their blackout period, and you lose the gamma support structure pretty much come this Friday to a large degree. So that opens up a window of weakness, I think, starting for next week, just as we're seeing Jerome Powell get a little bit more hawkish, just as we're seeing some more of these AI-related concerns that impact NVIDIA, which is obviously the highest market cap company that exists. So when all is said and done here, much movement, no direction is where we ended up. We'll see if we can get some tomorrow or not. Traditionally we always talk about how the day after a Fed day has a higher probability of being a trend day. And I do think that will hold true for tomorrow, but you still will have some degree of the same supportive structure that's out there that's insulating these moves. And it's insulating it, I think, a little bit in both directions. We should see some insulation into bigger upside moves as well. But we'll see if tomorrow leads to a trend day. The Fed day itself from 2 to 4 p.m. is very reactionary. It's very algorithmic. News algos ripping the market in one direction or the other depending on exactly what is said, parsing every single word in real time. But the bigger money managers, they take the night to think about it, and then they put money to work the next day So that's why the day after a Fed day has a higher probability of being a trend day than otherwise. Remember, generally speaking in the market, you can either have one of 2 days. You can have a trend day, or you can have like more of a non-trend day or a consolidation day. The average day is a consolidation day. I don't know what the exact statistics are, but I can tell you for sure there are more consolidation days in a given year than there are trend days in a given year. So if you were just to, you know, close your eyes and put your finger on any day on a calendar, there's a higher probability that day is going to be a range day than a trend day. But when does the probability of a trend day increase? It increases when there's news. So it increases the day after a Fed day. We'll see if tomorrow we get that. Based on today's price action, I would argue that it's a coin flip. If I'm just entirely talking about the technicals, I would argue it's a coin flip on which way that trend could be. You can look at the daily candle of the SPYs here. You can look at the daily candle of the Qs here and say they look very bullish. They're continuation hammers. We pulled back into the 80 MA on the daily chart. We found support. We found demand. We closed back near highs. They look like continuation hammers to the upside. If you look at the IWM, it's a nasty upside tail. It's a breakout failure and a nasty upside tail. We are, and this is one other important point, still in a market that's hallmarked by dispersion. And dispersion occurs in high gamma environments. So that makes plenty of sense. When will we see correlations increase? We'll see correlations increase if the market ever moves down. Throughout the day today, pretty much all day, the IWM and the Qs were moving literally opposite to one another. Post 2 o'clock, they weren't moving opposite to one another, but they were still like pretty extreme relative strength and relative weakness that was ongoing between those two indexes. So we'll see. You know, if you look at the daily candle, the SPYs and the Qs, it would say more likely to be a trend day higher tomorrow than lower. If you look at the intraday chart and how it kind of played out, I would argue it's a little bit more 50-50. When I think about the market dynamics, I actually think there's more risk to the downside than the upside. So you kind of go back to some of the same things that we've been dealing with for seemingly a long time now, which is a market dynamic that has more risk to the downside than the upside, but a technical trend that continues to be up. And you don't necessarily want to fight that trend. The important spots for tomorrow are going to be today's high and today's low. I think that's the first places that we're looking at, or basically beyond that, the all-time high and today's low. And we'll see which way those break, if they can break, and if there is a pickup in movement potentially to the downside starting early next week when we get through OPEX. Maybe they'll even front run it on Friday because I won't be here on Friday. So that wouldn't be surprising. I'm out on Friday, just as a reminder. I'm not here. So that's all I got. I am happy to take a look at anything that you guys have, any questions, any names, any of the usual fun stuff. All right, let's see. Not seeing a whole lot here in the VTF. IonQ moving on some news. IonQ signs memorandum of understanding with the U.S. Department of Energy to advance quantum technologies in space. It's pretty solid. Are we shorting a gap up tomorrow? I would rather assess that in the morning, Tate. Depends how big the gap is. I want to say yes. But I would rather assess it in the morning and see just how big that gap is, where it's gapping to, read the new research that gets published and see if that influences my thought process at all. So we'll see. But generally speaking, my thought process on that would be yes, short the gap up tomorrow. Over in the YouTube from Cyril, market is flat. That's insane dip buying in the market. What is the game plan for tomorrow? Do you expect a trend day? Yeah, I think I already kind of answered that one just in my overall review. Certainly insane dip buying is still ongoing in the market. We just reviewed the structural reasons behind that. Do I expect a trend day tomorrow? The day after a Fed day always has the ability of becoming a trend day, but the market dynamics are so insulated that it makes it more difficult for the market to trend than it would otherwise. So take that as you will. It's certainly possible, but you've got to be able to push through. Robert wants to know if it's only his stream that's cutting off. I don't know, Robert. I've been having internet problems today, and the guy's currently here working on it, so I hope I didn't lose you guys in the YouTube. I don't think I did. Apex Joy asking my view on gold. I still like it. You know, it's been a big move. A little bit of a pullback here is needed. I took off some extra GLD around 340 yesterday, so I lightened up my GLD position at 340. But for the moment, I'm interested in buying dips. There's a wide space between the 8 and 21 EMA. It could pull back to, 332, 333, and still be really healthy here. But I'm still generally speaking a gold bull. I don't know if I've ever said that before in my career. I'm generally speaking a gold bull. And I think that dips are buyable until and unless the technicals break. From Jackie in the VTF. As traders, how do you accept when your thesis has been wrong for so long that it caused you to miss big opportunities? For example, many traders who were long from April flipped short and got stuck in short ideas in June, July, while the market kept ripping. When sticking with the long from April and staying on the long side would have been much easier. Knowing how much easier and more profitable it would have been if they were the other way, how do traders get over that mentally? Is it better to just take it as a learning opportunity, or is sticking around with the original game plan more important than trying to flip the other way? This is a fantastic question. And I can tell you that for myself, for sure, I have underperformed the market. I had a terrible June. And then my July was okay. My August was pretty good, but I had like a terrible June. So I over the course of that 3-month period have definitely overall underperformed a bit. So I get it. I get where you're coming from, and it's not the first time for me. I also remember coming out of the COVID dip, which is a long time ago. I bought the bottom of the COVID dip to the day. We closed. I'm not going to bother zooming in, but we closed with a hammer. I will zoom in really quick. We closed with a hammer that day, and I did something that I don't typically do. I guess we didn't close with a hammer on the SPYs, but I think we did with some Apple names, some X7 stocks. Yeah, like this. I liked this downside tail here, and it was there a little bit with the SPYs. I remember on this day doing something I rarely do, which was buy at the close, starting new positions at the close. And then the next day we gapped up huge, and it turned out to be really fortunate. And then the rally continued. When the rally got, I don't remember the exact prices. I want to say when we got into this 280 to 290 area, I felt we had come too far too fast, and I was really almost similar to this bounce back, liquidating those longs very quickly, starting to initiate some shorts. And then I started losing money on those shorts as the market continued to go higher. And then I reassessed my entire situation. I got out of those shorts for a loss, but I didn't fully reinvigorate the longs either. I got out of the shorts for a loss pretty quickly, which was great, and I was less stubborn than I was honestly with this market cycle. But I got out of the shorts, took the loss in them, and I flipped back long, but not with massive amounts of size or anything, because it still felt like late cycle to me in terms of the bounce. And then obviously the market just continued to go up and up and up and up, and it turned out to be a full out V bottom. But the biggest thing for me, I would say, to answer your question, is you have to be willing to assess where the market is at any given point in time, what the data shows you, and adjust your game plan per what the data, what the information, what the technicals are showing you. And that means recognizing that you are wrong, or you're too early, and following a game plan where you're taking your loss in the trade. And it's some degree of what I did in this cycle. Like I got smoked in June, not just because I was short, but I was short the strongest stocks, and I was way too early on it. And I knew that if I didn't get my pullback in the second half of June, which I did not get, post that June OPEX, that's actually when we started ripping, uh, that's when I needed to take the loss. Because I knew that I couldn't be short in that way for July. July just has too much seasonal strength, and the trend is your friend, and everything seemed to be continuing higher, and the negative impacts of the tariffs were bleeding into the market too slowly, and the systematic bid, most importantly, was still huge going into the July period. So, it just is what it is. I took in the data, I took in the information, I recognized that I was wrong in June, I realized losses on some of the shorts that I had on, and got out of the way. And then I was able to be a lot more nimble in the July and August period because I did that. So I think that that's what you need to do. You have to learn to, and this is very hard for all of us, recognize like where are we now today. I'm not sure if I'm getting that point across properly, but yesterday's thinking is yesterday's, tomorrow's thinking is tomorrow's. Like where are we very specifically today? What are the risks? What are the to the upside? What are the risks to the downside based on where we are today? And maybe 2 weeks ago I had a thought process that was more bearish, but 2 weeks later, when that trade didn't manifest properly and now the data has changed, I need to change with it. And that means that you're going to have periods where you underperform. That is part of the business. It's literally part of the business, but you have to adjust and move on. That's part of what successful trading is, right? Successful trading comes down to when you have those thought processes and theses and you're correct, that you crush it. But when you have those thought processes and theses that are not correct, that you're able to minimize the loss and move on and adjust to the new game plan based on the new data. So I hope that helps. It's definitely from my own experience because I've been there on multiple occasions over the course of my career. I just referenced 2 of them within the last 5 years. And then it's about, readjusting to that new information and game plans. So hope that helps, Jackie. David L. saying a common phrase in the news this week has been, the stock market is not the economy. It seems self-explanatory, but curious to hear your further thoughts on that. Sure. That's also been in some of the institutional research we read. It was also in the Rubner note. I have it even right here, actually. The beginning. This is in the beginning portion of Rubner's note. They give you the bull case versus the bear case, and within the bull case, it literally says stocks are not the economy and strength can persist. So yeah, I'm happy to give you a little bit more of an explanation on that. The economy is right now, the stock market is forward looking, right? So the economy has gotten worse. There's another great chart that I've read. I don't think it was in Pat's note. Sometimes I'm reading so much research that I kind of can't keep some of it together on where I saw it. But there was a really good note. I wish I could find it. I think it was in the JP Morgan note that also had the percentages, which is not in Pat's note. Let me see if I can see it really quick on my other screen, because I want to pull this chart up for you guys if I can, if you'll bear with me for a moment, because I thought it was a good one. If I can't find it within 30-45 seconds here, then I'll just move on. But give me one quick second to try to find this. Tuesday morning's briefing from JP Morgan. I don't think that was it. No. Today was Wednesday. Goldman note, another Goldman note, another Goldman note, a Citi note. maybe it was actually one of these Goldman notes. Give me one more second. If I can't find it, I'm going to abandon it, and I'll just explain to you what I saw. But there was a really, really good chart that it showed. I don't fully remember. I think it showed S&P company margin versus the economy, and that I can't find it, so I'm going to bail on this. But I think it was like S&P margin versus the economy, and usually they move in tandem with one another. Like as the economy gets worsens, I guess I'm pretty sure it was margins for S&P companies. Margins get worse as the economy gets better. Margins expand, and they kind of move hand in hand. And right now there's a huge divergence between the two, where the economy has gotten significantly worse, but the stock market measure, which I think was an S&P 500 company margin measure, but I'm honestly not 100% sure, has not gone down with the economy. And you know why, right? It's because the stock market doesn't reflect where the economy is today. The stock market reflects expectations for the future. What the divergence right now between the S&P and the NASDAQ at all-time highs versus the economy with a worsening employment situation and slowing GDP and increasing inflation, where that divergence comes from is that the market is looking towards the stimulus that is coming from the Fed and from the federal government to be bullish. Fed cuts, right, which we saw starting today, plus like the big beautiful bill stimulus spending, the no taxes on tips and stuff like that, that are, you know, it's deficit spending, right? Deficit spending is bullish for the equity market. So the market right now, it's looking past this economic weakening and looking forward towards the solutions already here at our fingertips between easing from the Federal Reserve, and easing from the federal government, or stimulus spending from the federal government happening at the same time. So that's what is meant by the stock market is not the economy. The question to ask yourself is, what's going to catch up to what? When you have this divergence right now between the market and the economy, that's probably not something that can last forever. It's going to have to come back together. It can come back together from as the economy continues to get worse, because things like Fed cuts and deficit spending are not improving the economy, then the stock market will catch up to the economy. The economy will stay worse if unemployment continues to tick up. That's the biggest risk, right? By the way, and I think we got a taste of that from Jerome Powell today as well. The biggest risk to this stock market, the biggest risk of further deterioration in the economy, is if layoffs begin to increase, because firings have not increased. This is from Jerome Powell today. Firings have not increased, but hirings have not increased. So the jobs aren't there. If people begin to lose their jobs, which has not happened, the new job is not there. They can't just cycle right into the next opportunity for them. If that situation happens, and that's the reason why the Fed's cutting, because they think that their cutting is going to benefit this. If that happens, things get much worse, and the stock market will probably catch down to the economy. If that's not what happens, if Fed cuts plus fiscal stimulus enables the job market to hold in like it's kind of been doing, right? We're in this really, really unique job environment that has almost not been seen before, where labor demand is going down, but also labor supply is going down with it. And that presents the downside risk that Jerome Powell is talking about. But if that doesn't get any worse, because companies are able to do better because they can borrow more cheaply and they're not paying as much income tax, then the economy probably catches up to the stock market, if that makes any sense. So great question, David. I think that answers it, and I hope it helps. Back over to YouTube from Steven. How much weight do you actually put on back testing in your trading, and how do you adjust for the fact that every trading day is different? I don't put any weight on back testing. I don't back test. I don't put any weight on back testing. The best algo guys I know, which is really where back testing is known for, the best quantitative algo guys I know, they don't do any back testing either. They forward test. They run their strategies in real time, and what's working best they apply more money to, and what's not working they reduce money from. That's the best way to do it, because then you're catering to what the market is doing currently and not what the market has done in the past. I hope that answers your question. No problem, David. All right, gang. Anything else? Going once, going twice. All right. Well, let's see what happens tomorrow. Let's see how we gap. Let's see if the day after a Fed day becomes a trend day, or if any potential trend is just squashed out by the gamma levels of this environment. And this next 2 days plus next week, I think, has potential to be very, very interesting for our trading. Today we had a lot of movement but no direction, but the movement actually created a lot of great trading opportunities. I think we had some great callouts intraday as a team when that was ongoing, and hopefully we get more price action like that, because it's exactly the type of price action that we want. Have a great night, everybody. See you all tomorrow.